Hello, this is Will Allen with Centera Capital. We're in the heart of earnings season. We're going to give you an update today on what we've heard so far from a variety of companies. Also, first quarter GDP numbers came out today and they showed a 1.4% contraction in the economy. But if you do a deeper dive, news is a lot more positive than that headline number would suggest. Let's dig in. Well, needless to say, it has been a tough year so far in the financial markets. The stock market we've seen a lot of volatility. In fact, the average length of the decline of the stock market so far this year, when it has a down day, on average, we have seen the declines last for 2.5 days, which that is the longest decline since you have to go back to the late 1970s. And what we mean by that is, some of the bigger declines the market has seen over the last 10 years, let's take March 2020 when COVID hit, for example, that decline was very vicious and it happened really quickly. In basically 4 weeks, you had the S&P drop almost 40%. So it was a rapid decline. This time, we've had the markets basically heading south since late November. We've had periods of time like late March where we had about a 2-week rally that was pretty strong for the markets. But in general, when the market has had a down day, it hasn't been just one. We've basically had 2.5 days of declines on average when it's headed south. So it's been pretty rough for investors. Even worse is on the bond market side. So far this year, the Barclays Aggregate Bond Index, which is kind of the equivalent of the S&P 500 or the Dow Jones Industrial Average on the bond side, it's down over 9% year to date. That's the biggest decline to start the year ever for the bond market. And interest rates have been skyrocketing so far this year. That reduces the value of bonds. And so for bond investors, especially those who are in investment grade bonds, which that part of the bond market's down 13% for the year. Long-term treasuries, which we've talked about a couple times this year, long-term treasuries are down over 18% so far this year. Just unbelievable declines in value there if you hold a 20 or 30-year U.S. Treasury bond. So it was important to be conservatively positioned on the bond side. If you weren't, you've had some substantial losses. And so what has happened is the fact is there has been no place to hide so far. International stocks, emerging market stocks, bonds, and stocks here in the U.S. have all had a tough year. Cryptocurrencies haven't done very well. Precious metals and energy are kind of the two parts of the market that have done well. And so with declines in so many parts of the market, you can forgive investors for being very pessimistic right now. And if you take a look, we're going to put up 2 charts here to kind of show just how pessimistic investors are. Look at this chart that shows, this goes back, basically, you can go back 40 years. This chart goes back 10 years. It asked investors, how bullish are you? And you can see here that right now, only 18% of investors are bullish. If you go back the last 10 years, this basically is the most pessimistic investors have been in that time frame. Also, let's take a second look here at another chart. This is something called the U.S. put-to-call ratio. All you need to know here is when this chart is going up, that is more investors are concerned. They're buying what's called puts, which is they are estimating that they think markets are going to decline. And you can see here that currently we're back to levels that we saw at the lows of the market when COVID hit in 2020. Also very similar to where we were in the fourth quarter of 2018, near the lows there. Now, both of these charts that we just showed you are actually contrarian. You use them from a contrarian viewpoint. So typically, when you see high levels of pessimism, high levels of panic from investors, typically you look out 6 months, a year from that point, and stocks almost 100% of the time are much higher. Because you typically see these numbers when investors have kind of thrown in the towel and they've sold things. And so typically you're going to see strong market performance looking out. Here's the thing. We've said for the last 3 or 4 months that the first half of this year was going to be pretty challenging because the market is dealing with a Federal Reserve that is going to be hiking interest rates probably now next week by 0.5%. And then the market is forecasting that they're going to be hiking by 0.75% at their next meeting, which Fed governors have not come out yet and said that that's what they're leaning towards. But that's what the market thinks is going to happen. If they do that, that's the equivalent of 5 quarter-point hikes at these next 2 meetings. And so the truth is the market wants the Fed to go ahead and get this over with. Everyone now knows that the Fed made a major mistake last year, continuing to do their quantitative easing, printing $120 billion a month, and keeping interest rates at 0. And so now the Fed is going to try to correct that mistake without sending the economy into a recession. And that's what the market's trying to figure out now. If the Fed's going to be able to pull that off. What the Fed calls that is a soft landing, meaning they want to cool down the economy without sending it into a recession. So, right now, if you take a look at parts of the stock market, a lot of the cyclical parts, like housing and autos, for example, a lot of the companies in those parts of the market are down 35, 40, 45% in just 4 or 5 months. And so you can make a case that those parts of the market are pricing in a recession or at the very least a pretty significant economic slowdown. Now, let's touch on something that is very timely. The first quarter GDP, gross domestic product report, came out today in the US, and it showed a decline, a contraction in the economy in the first quarter of 1.4%. Now, a recession is typically defined as back-to-back quarters of a contracting economy, okay? This isn't going to be the start of that, or is very unlikely to be the start of that, though. And that is because economists expect that the second quarter, what we're in now, we are going to see an expansion. This first quarter, if you dig beneath the surface, actually the reason for the negative print on GDP is due to when we here in the U.S. Buy imports, that number actually reduces GDP. And that number was so large in the first quarter, combined with inventory restocking, we saw a slowdown in that from the fourth quarter. Those 2 factors are the reason we saw a negative GDP report. What's most critical in the GDP report is consumer spending, business spending, and housing. And in the first quarter, we saw a growth over the fourth quarter of last year of 3.2%. in that category. That's really critical. That's the health of the economy right there. That's the most important thing to look at. That was a positive 3.2%. Now, it is very possible when we get into 2023, if the Federal Reserve does go too far in their quest to stamp out inflation, if they go too far, and right now the market's pricing in 10 or 11 interest rate hikes in this calendar year, another 4 next year. But if the Fed does go too far and we do go into a recession, most economists believe it's going to happen in 2023. Currently, Goldman Sachs forecasts about a 30% chance that we have a recession in 2023. So when you hear that we had a contraction in the first quarter of 1.4%, don't become alarmed just yet. Believe in that, okay, this is the recession that has been discussed in financial media over the last couple months. Because again, economists believe the second quarter, the third quarter, those are going to be positive numbers because the consumer is really strong. And then the last thing I want to talk about in today's video is we're in the middle of earnings season. In fact, this is the busiest week for companies. And we've heard from a lot of different companies so far. And we've heard a pretty consistent message. And that is the consumer is spending money, especially on travel. We've heard from Visa, MasterCard, American Express, all had phenomenal numbers. And all of them said that the consumer is spending a lot, especially on travel. And even with, and for example, we also heard from Southwest and Delta, United, they said business has never been better. All of them are forecasting a return to profits this quarter and from here on out. Even with ticket prices up 25-30% over last year, it's not stopping. The consumer is spending to travel. So that is a very good sign for the economy. We've also heard from companies on the business side. Microsoft, for example, had a phenomenal quarter. They said business spending is strong as ever. They did not see any slowing. And we've also gotten similar kind of numbers from companies like ServiceNow, CrowdStrike, IBM, who have all said similarly, hey, enterprise spending is really, really good. On the retail side, as far as restaurants, McDonald's, Chipotle, we're doing very, very well. Lululemon had a great quarter on the apparel side. Again, said they have seen no weakening in consumer spending. And then on the transportation side, you've had companies like Norfolk Southern and J.B. Hunt who have said, hey, from our perspective, we have seen no weakening whatsoever either, as far as businesses moving goods from one side of the country to the other. Now, it hasn't all been great. Companies who really benefited when the pandemic hit and from people staying at home, we've seen a real struggle from those kind of companies. The best example of that is Netflix, which, as many of you probably heard in the media last week, dropped 37% in one day because they had a loss of subscribers for the first time in a long, long time in the first quarter, and they projected an even larger loss in subscribers here in the second quarter. They said, look, people are out and about. They're traveling. They're not watching nearly as much TV as they had been. And we've seen that kind of across the board. Another company, Teladoc, today is down 45%. They were, again, a big stay-at-home winner. So those parts of the market are really, really struggling. And then we've had a couple one-offs, companies like Boeing, which really should be doing wonderfully well right now, given the demand from airlines, but they have a lot of self-inflicted wounds. That stock got punished severely yesterday for having a really poor report. So we do see some examples of companies just not executing. But all in all, first quarter numbers have been pretty darn good for companies, and guidance has been pretty solid across the board, especially by companies that are consumer oriented. So again, we expect as we go later in the year that there is going to be an economic slowdown. And so we're just going to have to see and watch closely with what we hear from companies to see the significance of the slowdown. But what we're seeing currently, we do not believe we're going to have a recession in 2022. Again, the economy is just too good. Consumers have too much money to spend. Checking account balances are at all-time highs. We heard that from Bank of America just 2 weeks ago. That's still the case. And the jobs market is really, really strong. You still have 11 million job openings. There's only 6 million people unemployed. So that's going to weaken as we get later in the year, and the impact of the Fed rate hikes that are coming up, start to play out. Mortgage rates are at 5.5% today on a 30-year mortgage, up from 3% just 6 months ago. That is going to have an impact. That is going to slow housing. But again, as long as we see consumers remain resilient in their spending, as long as the job market continues to be good, a recession doesn't seem like that is the base case. And if not, a lot of parts of the stock market and a lot of the bond market that has been hit really hard so far this year, there's going to be a lot of really good values looking out 12 months, 18 months. We'll keep an eye on it and give you updates as we go along. Thanks for watching and take care.